I want you to picture something for a moment. You look back at the last 12 months of your business. The business has been busy. The team's been working hard. Revenue's up. You have done more work than the year before. But then you look at the profit number and it's barely moved, or it has moved, but nowhere near as much as the extra work should have produced. And of course, you sit there trying to work out where it went, because the logic seems simple enough. More work should mean more profit. That is how it's supposed to work, right? But that's not always what happens. And the reason is something most business owners never see coming. It's not one big problem. It's not a catastrophic mistake. It's not even anything, dramatic. It's a series of small amounts leaking out of the business quietly, consistently, and completely unnoticed. And when you add them up, they are costing the business tens of thousands of dollars a year. So today I want to show you exactly what those leaks look like, how to find them in your own business, and what to do once you have actually found them. So hi, I'm Jen Richardson. I'm the founder of 123 Financial Group. We work with small business owners across trades, constructions, and service industries. And finding profit leaks is one of the most consistent and impactful things we do when we start working with a new client. Almost every business has them, and almost no one knows exactly where they are until someone goes looking. Let me define this properly, because the term gets used loosely. So a profit leak is anything in your business that reduces your margin without a corresponding or intentional decision to allow it. That last part is actually important. There are things you choose to spend money on that reduce margin deliberately. Investing in a new team member, upgrading equipment, spending more on marketing. Those are not leaks, those are decisions. A profit leak is the opposite. It is margin being eroded by something you either do not know about, have not noticed, or have noticed but have not yet quantified. And the reason profit leaks are so damaging is not that any single one of them is catastrophic. It is that they are cumulative, they're consistent and invisible until someone deliberately goes looking. So let me show you what I mean with a number that tends to land with business owners the first time they hear it. Say you complete 10 jobs in a week, and each job is underpriced by just $100. Maybe because your rates have not kept up with what materials and labour are actually costing. Maybe because you quoted without fully building in all the costs. Maybe just because the number felt like a round number when you put it together. So that would give you $1,000 a week leaking out of your margin. So $4,000 a month, more than $50,000 a year. Not because anything went wrong, just because nobody was watching that number closely enough. So that is what a profit leak costs, and that is just one leak in one area of the business. So let me walk you through the 7 most common profit leaks I see in small businesses. As I go through those, what I want you to be is honest with yourself about which ones sound familiar to you and your business. So leak number 1 is pricing that has not kept up with costs. This is the most common leak of all, and it is almost universal in businesses that have been operating for more than a couple of years. So when you first set your prices, they were based on the cost of materials, labour and overheads at that time. But costs do not stay still. Material prices have increased significantly in recent years. Labour costs have gone up, insurance, fuel, software subscription, everything has crept higher. But the prices charged to clients have often not kept pace. Not because anyone made a decision to absorb the extra cost, just because no one did a systematic review and the rates stayed where they were. The result is that the margin on every job has quietly narrowed. The business is doing the same amount of work for less return than it did 2 or 3 years ago, and the owner often has no idea it has happened. Leak number 2 is quoting without knowing the real cost. This one is subtle, but it's significant. When you quote a job, are you quoting based on what you think it will cost, or based on what jobs like that actually cost when you go back and look at the numbers? Most quoting is done from experience and intuition, which works reasonably well most of the time. But intuition does not account for the cost creep in materials, the extra hours that end up on certain job types, or the overhead allocation that is easy to underestimate when you are in quoting mode rather than analysis mode. The gap between what a job was quoted at and what it actually cost to deliver is where a lot of the margin disappears. Leak number 3 is doing work that was not in the quote. This is one of the most emotionally loaded profit leaks because it involves a conversation most business owners would rather avoid. The scope of a job changes. The client asks for something extra. A problem is discovered on site that was not anticipated. And rather than having the conversation about the variation, the work just gets done because it feels easier, because the relationship matters, because it does not feel worthy of the awkwardness. But across a year of jobs, that unrecoverable extra work adds up to a significant amount of revenue that was earned but was never invoiced. The labour happened, the materials were used, the margin, well, it just never made it onto an invoice. And leak number 4, jobs taking longer than quoted. Labour is usually the biggest cost in a service or trades business, and labour overruns are one of the most consistent margin killers. A job quoted for 8 hours takes 10. A project estimated at 2 weeks runs to 3. Those overruns might have legitimate causes: unexpected complication, delays outside your control, scope that expanded slightly. But if they are happening consistently and nobody is tracking them, nobody knows whether it is a quoting problem, an efficiency problem, or something else entirely. The hours just disappear into the job and the margin goes with them. And leak number 5 is overhead creep. This one is particularly sneaky because it happens gradually and individually. Every increase seems reasonable. A software subscription here, an insurance renewal that went up, a new tool account that seemed useful, a vehicle cost that crept higher. None of these feel significant on their own. But overheads that are not reviewed regularly have a way of expanding to fill the available margin. And when they are finally examined properly, business owners are often genuinely surprised at what they are spending and on what. And leak number 6 is unprofitable clients or job types. Because not all work is equal. Some clients are straightforward, pay on time, and the job runs smoothly. Others, well, they require constant management, change their minds, pay late, and drain time and energy that could be applied elsewhere. Some types of jobs consistently hit margin, others consistently fall short. But without looking at the profitability by client or by job type, there is no way to know which is which. The business treats all work as roughly equivalent when the reality is that some of it is actively dragging the average down. Leak number 7 is no minimum margin discipline on quotes. This is about what happens when work is slow or when a client pushes back on price. Without a clear minimum margin in mind, quotes get adjusted under pressure. Rates get softened to win work. Discounts get offered that were not planned for. And the problem is not the individual discount, it is the absence of a floor. When there is no defined minimum margin that the business will not go below, decisions about pricing get made on feel rather than on numbers. And on feel, the business nearly always loses. So how do you actually find out where the profit is going in your specific business? Here is a 4-step process that works. So step number 1, pull your gross profit margin and compare it to last year. In Xero, run your profit and loss report for the current year and the previous year side by side. Look at your gross profit margin, which is revenue minus direct cost, divided by revenue expressed as a percentage. If that percentage has declined year on year, profit is leaking somewhere between the top line and the gross profit. That is usually pricing, quoting, or job cost overruns. If gross profit margin is holding but net profit is declining, the leak is in the overheads. Costs have grown faster than revenue. That single comparison tells you which part of the business to look at first. Step number 2, review your last 10 jobs with actual cost data. For each of your last 10 completed jobs, compare what you quoted against what the job actually cost to deliver. So I want you to look at materials, labour hours, subcontractors, and anything directly attributable to that job. If you are using Xero and tracking job costs, this data is already there. If you are not tracking job costs, this exercise will make a very strong case for starting. What you are looking for is the gap between the expected margin and the actual margin on each job. And then look for patterns. Are certain job types consistently over budget? Are particular clients always generating variations? Is one part of the process reliably blowing out? Patterns tell you where the system needs to change. A one-off overrun is bad luck. A consistent pattern is a structural problem with a structural solution. Step number 3, though, is line by line your overhead expenses. Pull your expense report in Xero and go through it line by line. For each item, ask 2 questions. Is this still necessary? And is this the best rate available? Subscriptions that are no longer used actively, insurances that have not been reviewed in 3 years, supplier accounts where pricing has crept up without renegotiating it. These are all candidates for reduction. This exercise tends to surface between $1,000 and $3,000 of overheads that can be reduced or eliminated without any impact on the operation of the business. That is not life-changing on its own, but it is immediate and it is real. Step number 4 is to calculate the cost of your unquoted variations. For your last month of completed work, estimate how many hours was spent on the work that was actually outside the original scope and was not invoiced. Multiply those hours by your effective hourly rate. That number, annualized, is the cost of your variation habit. For most trade businesses, it sits somewhere between $20,000 and $80,000 a year. Seeing that number tends to make the variation conversation feel considerably less awkward. Once you have found your leaks, the instinct is to try and fix all of them at once. Do not. Pick the one that is costing the most and start there. For most businesses, that is pricing, because it affects every single job from the moment you fix it. A pricing review does not have to be dramatic. It might mean increasing rates by 5 to 10% to reflect what costs actually are today. Most clients will not leave over a well-communicated, justified price increase. The ones who do will probably margin jobs anyway. Once pricing is addressed, move to quoting accuracy. Build a simple template that forces you to account for all direct costs before the quote goes out. So include things like materials, labour, hours at the real rate, subcontractors, a margin buffer for scope risk. Then address variations. Draft a simple variation process. Even a one-page document that makes it normal and expected to charge for work outside the original scope. Frame it as professionalism, not confrontation. Clients who value your work will respect it. The goal is not to fix everything in a week. It is to close one leak at a time and let the cumulative effect build. Every percentage point of gross margin improvement flows directly to the bottom line. So here is a question that is worthy being genuinely honest about. Of the 7 profit leaks I just described, how many of them are happening in your business right now? Not might be happening, are happening. Because for most business owners, the answer is at least 3 or 4. And the combined cost of those leaks is almost always larger than expected. The good news is that every single one of them is fixable. None of them require the business to grow. None of them require more work. They just require someone to look at the numbers and make some deliberate decision. So if today's video has made you want to take a proper look at where your business stands financially, I've created a free tool called the Profit Engine Scorecard. 15 questions, about 10 minutes to complete, covering 3 areas. How clearly you understand your numbers, how well your financial structure is set up, and whether your business is actually building profit or just revenue. The growth section of the scorecard in particular is designed to surface the kind of margin and pricing issues we have been talking about today. The link I've put in the description so you can download it, but I want you to go through it honestly. So if you go through the scorecard and you want help finding and fixing the profit leaks in your specific business, that is exactly what we do at 123 Financial Group. We sit down with business owners, go through the actual numbers and identify where the margin is going and what changes will make the biggest difference. We work with small business owners in Newcastle and across Australia. The Clarity Call in the description is a straight conversation about your numbers with no pressure and no pinch. The information, of course, in this video is general in nature and it does not take into account your personal or business circumstances. Please seek professional advice before making financial decisions. Most businesses do not need more work to become more profitable. They need to keep more of what they already are earning. And once you know where the money is going, you can start making decisions that actually change the outcome. Give this video a like if it helped and subscribe, because next week we are talking about something that catches a lot of growing businesses off guard. What it actually costs to hire someone and how to know whether your business can genuinely afford it before you make the commitment. Your business should support your life, and I'll see you in the next video.